Due to deregulation since the 1980s and the idea of laissez-faire capitalism, banks were able to have free rein on the market. This lack of government regulation on big banks and the push to increase home ownership allowed for speculation and fraudulent loans by big banks. While housing prices and default rates on mortgages skyrocketed, almost all analysts assured the public that the housing market could never crash. Through giving out unsafe mortgages and compiling these subprime mortgages in large bonds and CDOs, banks were able to delay the crash and expand the problem through increased speculation. Along with this, rating agencies were paid or forced to give AAA ratings to all of these mortgage-backed securities to stay in competition. When the market crashed, the government had to bail out the banks because they lost almost all liquidity and couldn't make any deposits. As a response to the crash, Congress and the President passed the Wall Street Reform and Consumer Protection Act, increasing the standards of giving out loans, increasing government oversight on banks, and placing Fannie Mae and Freddie Mac under the control of the government. In the 1980s, the United States underwent a process of deregulation on banks that undermined the progress of the New Deal. Firstly, one must know the function of the Federal National Mortgage Association, also known as Fannie Mae. This was developed in 1938 as a part of the New Deal to secure and purchase mortgages so that banks always had the money to give out loans. In 1970, the Federal Home Loan Mortgage Corporation, Freddie Mac, was created. Similar to Fannie Mae, this was meant to purchase mortgages, but Freddie Mac grouped these mortgages together and then sold them as bonds on the market. Overall, this increased home ownership and speculation in the real estate market. In 1980, the Depository Institutions Deregulation and Monetary Control Act was signed by Jimmy Carter. This was the beginning of the end for the housing market. This act gave banks the freedom to set their own interest rates on loans and allowed banks to merge. In simple terms, this meant banks got bigger and were able to gain more money off the loans they gave out. This is similar to the stock market crash of 1929. During the Roaring '20s, there was also a lack of government oversight. Large investors could do scams such as pump and dump and insider trading. This allowed them to gain leverage over the whole market. Similar to the housing market, the stock market was believed to always go up and never fail. And just like the housing market, it took only a small period of time for the market to collapse. Part of the problem was that investors were able to buy stocks on margin instead of paying the whole price for them, which led to unrealistic speculation and huge debt when the stock fell. This is similar to subprime housing loans, which were given with little to no down payments. In both cases, lack of government oversight played a huge role in allowing crony capitalism to take advantage of everyday Americans. After the stock market crash, there was a 10-year-long depression, and it required the New Deal, which was composed of a new regulatory laws on banks, such as the Glass-Steagall Act. In 1994, President Bill Clinton repealed the part of the Glass-Steagall Act which prohibited a bank holding company from owning other financial companies. This basically allowed companies to own banks, and the government couldn't interfere. In 1999, Glass-Steagall was fully repealed, and as a part of Bill Clinton's Housing Urban Development Act, banks were encouraged to give loans to those with bad credit. This was meant to make housing more affordable, but it also allowed banks to take advantage of poor people with subprime mortgage loans. Subprime mortgages are basically mortgages that statistically have much higher default rates and usually have adjustable interest rates. So with subprime loans, banks could advertise a low initial cost, but then after years they could adjust the rate of interest on the loan. This is considered mortgage fraud, and from 1999 to 2004, mortgage fraud went up 600%. However, for low-income families, they seem like a great choice, with a low initial cost. During the 2000s, President George W. Bush wished to continue this goal of expanding home ownership, especially to minorities with low credit score.
More and more people own their homes in America today. 2/3 of all Americans own their homes. Yet we have a problem here in America because fewer than half of the Hispanics and half of the African Americans own a home. That's a home ownership gap. It's a gap that we've got to work together to close. And by the end of this decade, we'll increase the number of minority homeowners by at least 5.5 million families.
Peter Wallison explains how, by the mid-1990s, in order to comply with the affordable housing quotas imposed by HUD, Fannie Mae and Freddie Mac were already acquiring mortgages with down payments of only 3%. By 2000, they were advertising for mortgages with no down payment at all. This method of giving houses to those who didn't deserve them worked. In 2004, U.S. home ownership was at an all-time high of 69%. And between 2004 and 2006, Fannie Mae and Freddie Mac bought another $400 billion of securities backed by the subprime loans. These subprime mortgage bonds became so risky as they were compiled with worse and worse loans. Not only this, but Fannie Mae and Freddie Mac were buying and selling these bonds to foreign and domestic markets, rated AAA. This large bond market, based on faulty loans, led to a large-scale crash. The government only licensed 2 rating agencies to give ratings on these bonds, and the banks selling the bonds paid off the agencies to inflate ratings. Overall, deregulation, encouraging home ownership by allowing banks to give bad loans, and buying the mortgage-backed securities tied to these loans were the main government policies that led to the crash.
Bad banking practices such as giving risky loans and increasing speculation through the bond market caused the crash. Firstly, a New York Times article right after the crash describes how everyone involved in the financial markets misled the public by constantly ensuring that the housing market could never crash, housing prices could not fall across the board, and that most of the bets made by Wall Street traders were inherently safe. The sentiment that the housing market could never fail was the reason the market was a bubble, because most people involved in the market couldn't see the inherent problems in housing. This bubble was mainly maintained by the corrupt rating agencies who almost always gave AAA ratings to mortgage bonds without looking at the loans within them, because they believed there was no way hundreds of homeowners would all default on their loans at the same time. However, when default rates reached 8%, subprime mortgage bonds would completely fail and the market would crash. The type of thinking that the housing market, which had historically been stable, would never fail led to the crash. Along with this, the creation of CDOs worsened the effects of the crash. Basically, when a bond failed to sell, instead of just not selling it, banks would throw it in with a bunch of more failed bonds into which what was called a centralized debt obligation.
What allowed a housing crisis to become a disaster? Here's world-famous chef Anthony Bourdain to explain.
I ordered my fish on Friday, which is the mortgage bond. So what am I going to do? Throw all this unsold fish in the garbage? Take the loss? No way. Whatever crappy levels of the bond I don't sell, I throw into a seafood stew. It's not old fish. It's a whole new thing. That is a CDO.
On top of this, because there are only a limited amount of mortgages, banks synthetically created pools of mortgage-backed securities that were tied to no actual assets. This type of bond was called a CDO squared, or a synthetic CDO. This led to a huge market in insurance on bonds rather than the bonds themselves, which only increased the collateral damage of the crash. However, the main cause of the housing crash were the adjustable rate subprime mortgage that were given out. People had the hope of flipping the house for a large gain. In fact, this tactic worked well when home prices were soaring. Other subprime borrowers were lured into their mortgages by the initially low payments, but when these teaser rates reset to current market rates, many homeowners could not afford the new, much higher payments. These teaser rates were readjusted to higher rates in the third quarter of 2007, and this is when default and delinquency rates soared. Overall, the bank's practice of giving out adjustable rates on subprime loans increased the default rates on mortgages, which were clumped into risky CDOs that increased the collateral damage of the crash. The housing market crash caused many banks to fail, a stock market crash, a decrease in housing prices, more government regulation on banking, and a bailout of the banks. Default rates continued to soar as the effects of the adjustable rates continued to impact the market. Immediately after the crash, many banks ran out of liquidity and completely shut down. The Guardian reported that Lehman Brothers went bankrupt. Merrill Lynch, AIG, Freddie Mac, Fannie Mae, HBOS, Royal Bank of Scotland, Bradley and Bingley, Fortis, Hypo and Alliance, and Leicester all came within a whisker of doing so and had to be rescued. This article was right after the crash and reflected the author's point of view that the financial system was falling apart. The rescue, or the Emergency Economic Stabilization Act of 2008, was a government bailout. This act was a $700 billion purchase of failing mortgage-backed securities, and also just a direct cash payment to the banks. This was seen as unfair from the point of view of the taxpayers, as shown by this political cartoon, where the taxpayers are having to solve the financial crisis caused by the banks. However, at the time, it was seen as the only option to stabilize the economy. Along with this, on September 6, 2008, the Federal Housing Finance Agency put Fannie Mae and Freddie Mac under government control and completely structured them. After this, Congress also passed the Wall Street Reform and Consumer Protection Act on July 21, 2010. This act was able to be passed due to the fear of bank fraud at the time. It was created to protect the American taxpayer by ending bailouts, to protect consumers from abusive financial services practices, and for other purposes. The act increased government oversight on banking and attempted to streamline licensing standards by requiring information for loans including name, home address, social security number, gender, date of birth, and principal business location. However, it was still criticized by many because of the politicians' financial relationship with the banks. Overall, the whole housing market failed following the crash, and many banks, having invested heavily in $1 billion of CDOs and failed mortgage bonds, went completely bankrupt. Following this, the government responded with strong regulation and a huge bailout that stabilized the economy and reassured public opinion, but was seen as ineffective and unfair by many critics.
Many people point to the lack of government involvement in banking as the core issue that caused the crash of 2008. This is true, but government also got involved in a negative way by promoting affordable housing, which led to banks giving out bad loans. On top of this, banks increased the damage of these risky loans by packaging and repackaging them up into securities and selling them on domestic and foreign markets. Rating agencies that were influenced by the banks and the government rated these securities AAA, despite the fact that they were filled with very risky, adjustable subprime loans. After the crash, housing prices plummeted, default rates soared, and the banks required a large bailout that ensured these banks that their risky practices would always be supported by the American taxpayer. Nevertheless, under Dodd-Frank, many of these bank practices were stopped. Although fraud is still prevalent in banking and the housing market, regulation on the loan system and bank speculation has improved.